What are the most effective ways to use the trigger points? Great question. So let's try to answer it. It is one of EG's most popular products, and one that I'm sure you have probably used or currently use, and that is the trigger points. You more than likely have a better understanding of what the trigger points potentially are now that we have run through topics like support and resistance and auction market theory with supply and demand and so on. The trigger points are plotting that on your chart for the next day. Okay, so all of the elements we talked about, support, resistance, supply, demand, the trigger points are giving that to you, or what the algorithm believes that to be, for the next trading day. One important thing about the trigger points to discuss is, what does it mean when sometimes you have trigger points that are very close together and sometimes you have trigger points that have a much larger distance between them? Say, for instance, a couple points here and 25, 30 points here. Theoretically, this can be viewed as a essentially band of support, really just combining these two, adding what I would consider to be extra strength to this point. So it's saying, okay, we've determined, the algorithm is saying it has determined that support 0 should be here and support 1 should be here, which means there's more than one instance that it has looked at and said, this is a high probability area for there to be support. So it's basically like stacking over time. Let's just say for example here, that support 1 here, okay, S1, was some type of price action from 2 weeks ago, where the market saw multiple touches and could not break below. And then let's say support 0 is, taking into account a high percentage or a high degree of its determination as to where it should be based on the previous day's low of day. So then you're essentially getting confluence here that, hey, there is a very high likelihood of some type of reaction at this point. And then up here, we have a little more distance between res 0 and res 1. And we can really, even though there's more distance here, we can almost view it in the same way, and that these two are still relatively close together in terms of point spread. I mean, you're talking on NQ maybe 15 points or something, which, we all know NQ, you get 30, 40 point candles. So this isn't, a crazy distance between the two. You can really almost view this in the same manner, in that, okay, this is your initial line of resistance, which, hey, this is pretty strong. Res 0 is always option number 1, high probability for a reaction, and it should be well respected or respected most of the time. But then when you have another level so close, when we're looking at it from the standpoint of supply and demand and orders in the market and interest of, sell side interest, so on and so forth that we've discussed, it's fairly easy to just then say, okay, it makes sense that these two can, in a way, be combined into just a band of resistance or a band of supply. Okay. This is another chapter entirely. When I see this price action and I see the way that it's moving here in that, let's look, we're just going to take a line and literally draw from here to here. It is very clearly to see, number one, this is not natural price action. And number two, price is moving lower. So with that, and in knowing that this is some type of algorithm designed to sell the market, we then move to open. About an hour and a half after the market opens, we get this area of consolidation, which we've seen time and time again. This is a flag pattern, which we're going to discuss in the next section in terms of common trading setups. But this is a flag pattern, and again, what do we see here? We're on the 3 minute on NQ. What do we see here that we have discussed time and time again? Look at the candles. Look at the price action here. Which side has more pressure, more interest here? We've moved close to where we believe for there to be supply. Okay. But yet, what's happening here? We're not seeing sellers aggressively step in. In fact, we're seeing the opposite indicated by these long bottom wicks. We very clearly see a buy-side presence and buy-side pressure here, buying these candles up again and again and again. Okay, and the volume in terms of the consolidation phase of this flagging pattern is not necessarily as important. It's traditionally on lower volume, but as long as it's not, on high volume and you're getting a bunch of sellers come in, that will definitely invalidate it, and you'll see that reflected in the price action. But based on everything we see here, there's no reason to believe that we're not going to move up and test this. And so with that, really the trigger point algorithm is finely tuned to give us the highest probability areas for price to react the next day. But there's always a but. It's like anything, never a sure thing. And we can see that here when we look at price on the next day. So with that, there's a basic overview of what the trigger points are. Now, we're going to get into the most effective ways to use them and how to view them intraday for the purpose of trading.